Hello and good afternoon, everyone. We'd like to welcome everybody to this event around the key inheritance tax changes and forward planning opportunities to be considered ahead of the upcoming budget on the 25th of November and the end of the tax year, the 5th of April. If anyone has any technical issues, feel free to contact us using the chat function. There will be a Q&A session towards the end of the event, so if you have any questions, feel free to put these into the Q&A box and we'll address these at the end of the session. It's fair to say that the inheritance tax landscape has changed quite significantly compared to 12 months ago, with the new Labour government and the announcements made in the budget on the 30th of October 2024. Today, we wanted to explore some of the most important inheritance tax actions that business owners need to be considering before these two upcoming deadlines. We'll take a look at some robust forward planning options, including examples of how these options have benefited a number of our clients. As always, anything we say on these webinars is general in nature, and it's important you don't take any steps without getting advice specific to your circumstances, so as to avoid any unexpected tax consequences. My name's Harry Cook, and also on the panel this afternoon, we've got Jerry Surtees, our tax partner here at Oldfield Advisory, and Joe Brewer, a consulting partner here at Oldfield Advisory. Today's discussion points will include an autumn budget from 2024 recap, key actions ahead of the next budget, essential changes to wills, key planning steps ahead of business sale or exit, removing capital value from your estate, some case studies, and then a live Q&A with our experts, Joe and Jerry. So what's been going on then, Joe?
Thanks, Harry, and welcome to all, and thank you very much for attending this webinar this afternoon. Great to see so many attendees. The autumn 2024 budget was pretty radical in its bearing and included a series of significant tax hikes. The tax increases were largely targeted at businesses and also wealthier individuals. So in addition to large tax rises in employers' national insurance, increased rates of capital gains tax, increases in stamp duty, and also the introduction of VAT on school fees, there were two devastating blows to the entrepreneur that are really and particularly relevant to today's webinar. These two fundamental changes concern inheritance tax. So firstly, on pension funds, from April 2027, pension funds previously outside the scope of HMRC's clutches, you might say, regarding inheritance tax, they will become part of an individual's estate for inheritance tax purposes and therefore will be taxed at 40% on death. Secondly, business property relief and agricultural property relief from April next year, so that's April 2026, the current 100% relief rate will be capped at the first £1 million of value, with only 50% relief on amounts above that. So, for example, that means an effective 20% rate of tax on share values over £1 million. And of course, further changes are possible in the upcoming budget in November, and changes may well limit the ability to mitigate these new measures. So historically, basic tax planning has always been to invest or retain money in company shares and also in pension funds, because it's been protected from IHT or inheritance tax. But now that's changed. We should plan assuming the changes are here to stay. A new government may not be able to afford to change things back to how they were. And so the purpose of this event is to firstly show that there are concrete steps that can be taken to mitigate these exposures, and also pointing out the urgency of considering action ahead of the upcoming dates. And on that note, I'll hand you over to Jerry to talk about some key deadlines and actions you should be considering ahead of these dates. Over to you, Jerry. Thank you.
Thanks, Joe. So we're really talking here about key actions to be thinking about ahead of the budget. Up till recently, we've been talking about getting things done ahead of the tax year end, and there is a specific deadline at the tax year end in relation to putting certain assets into trust, particularly shares, which will be easier to do now than it will be in coming tax years. However, right now, the critical date we're thinking about is the budget, which is the 26th of November. And there's been a lot of speculation about what might change in the budget. And one thing in particular that's got a bit of press has been changes to the gifting rules for inheritance tax. As most would be aware, you've got your 7-year rule, which means you can give away as much as you want to a family member or a child, and that passes out of your estate after 7 years. What might possibly change on that? Well, there's a couple of things possible changes we can think of. One is that the 7-year timeline might be extended to 10 years, which would mean that instead of having to wait 7 years, you'd have to wait 10 years before it falls out of your estate. Or the other thing that's being talked about is a potential cap on lifetime gifting, so that you're not allowed to give away more than X, whatever that figure might be in your lifetime, without it being subject to an immediate tax charge. And these are changes that could potentially come into effect immediately from budget day. So what does all of this mean? Well, what it means is that for anybody that's concerned about the effect on their inheritance tax exposure of the new rules, or for that matter, they've got a business sale event planned in the coming years, and there's going to be some more on that later, they should be thinking seriously now in this window of opportunity we've got between today, the 18th of September, and the budget day, 26th of November, about using that opportunity to get value or assets out of their estate before that date. One important point we did want to make at this point is that gifting in this context, in the context in which we're talking about it, is not necessarily the same thing as losing control. And to try and illustrate this, there's 3 different elements to any asset that you own. There's the capital ownership, capital value, that's what you get taxed on. There's the control of that asset, who decides what happens to it, what you do with it, etc. And there's the income that's generated from the asset, whether that's rental income on a property or dividends on shares. And in the normal way, when you give away an asset in normal circumstances, for example, a property or some shares to a family member, you're giving away all 3 of those things. Therefore, you're losing the capital value is going, subject to the 7-year rule, which is the bit you get taxed on, so that's helpful for inheritance tax. But you're also losing the control over that asset and the income that's generated by that asset, which isn't necessarily what you want. So as we've set out on this slide here, one of the strategies we're going to be talking about a bit today is a way of gifting without losing control and without losing access to income. So you get the capital value out of your estate. That's the bit that you're taxed on. So we get that out of your estate, but you retain control and you retain access to income. So just to be clear, when we're talking about gifting, we're not necessarily talking about giving up control or access to income, and we will come back to this in a bit more detail later. What other things do we need to be thinking about ahead of the budget? Well, the other area that is potentially up for change is what's generally viewed as quite a generous inheritance tax exemption for what's known as regular gifts out of surplus income. This is seen as a generous relief, because it's uncapped, it's unlimited. It's also going to be a very useful relief, particularly for those that have got a lot of money in pensions, as a way of getting that value out of your estate, either prior to or following that coming into force from April 2027, as Joe's touched on. So for those that are wanting to utilize that gifts out of surplus income exemption, it's important to think about at least starting that process ahead of budget day and have a plan for further gifting as well where necessary. And we can help with how that should be structured to make sure you fit within the exemption. There's some particular considerations with that. the point here is that the benefit of this exemption is that if you fit within this, any gifts that fit within this fall immediately out of your estate. There's no 7-year wait, it's immediate. So it's a very useful exemption that might be limited in some way in the budget. This is a key question, and clients often say to us, the challenge is, we don't know how much we're going to need, we don't know what we're going to sell for, we don't know what the shares are worth. There's lots of unknowns. How much should we give away? And this is a challenge, and inheritance tax planning is always involves this kind of element of trying to predict the future. All we can really do, I think, is make some sensible projections, try and make sure we build in some safeguards along the way, which we can do, to guard against what you might call some unforeseen scenarios. But I think one big message that we wanted to make this afternoon is to guard against what you might call inertia, for want of a better word. I guess with all of us, the temptation is always, if I'm not really sure what to do, well, I'll just do nothing and hope for the best. Hopefully the government changes, hopefully the rules will get reversed and everything will be fine again. And we're not really recommending that approach because it's hinging on a lot of uncertainties. But at least I think if you decide to do nothing, it should be a considered decision, not just a default position. And ultimately, when it comes down to gifting, within reason, you're better off doing something than nothing. So even if you start with a smaller amount that you're comfortable with doing ahead of the budget, subject, of course, to any budget changes that might restrict us in some way, you can always do more later. As always, the key thing is to, of course, take advice before taking any significant steps, particularly where there's significant values or amounts involved, as there can be immediate tax consequences of gifting in certain situations. So it's very important to get specific advice. The next thing we wanted to touch on was wills. And we want to emphasize this point that every married couple who owns shares in a trading business needs to revisit their wills. And there's a fundamental reason for that, which is to do with how the new £1 million allowance works. So under the new rules, every individual has a £1 million allowance that they can use for shares or assets qualifying for business or agricultural relief. You've got £1 million allowance per individual. That's on top of your nil rate bands, which cover your personal assets. This is specifically for business assets. So for a couple, you can potentially pass up to £2 million of shares without tax-free under the new rules. The important point here is that the £1 million allowance, unlike the other allowances, is not going to be transferable between spouses, we've tried to illustrate on this slide here. So that's unlike the other nil rate bands and so on. They're all transferable. The £1 million allowance won't be, which means that you have to use it on first death. And most wills are not designed to do that. You will need a bespoke will, which utilizes that allowance. Some may already have bespoke wills in place, which will do this, but I wouldn't take it for granted. I would definitely get it reviewed and check that it does what it's meant to do and it works in the optimal way under the new rules. Just to sort of re-emphasize that point, I think it's important for everyone to understand that under the new rules, you can no longer just pass everything to surviving spouse and automatically get the benefit of the reliefs. The £1 million allowance can't be passed to surviving spouse. You've got to do something different to make sure that you can utilize your £1 million allowance on first death. The second point we wanted to make on wills is quite a specific point in relation to what's known as a double dip will, which some on this call may already have in place. There's some changes under the new rules, but they are still effective under the new rules, still deliver significant tax savings in the right circumstances. And fundamentally, they allow a married couple to effectively double up the amount of relief that they benefit from holding shares in a trading company or group. However, our observation is that most, if not all, double dip wills that we see are in an old format, which is no longer the most optimal way of structuring it. So with the old format, it still works for inheritance tax, but typically you're likely to incur a stamp duty land tax liability in the process of implementing the so-called double dip. And we came across a recent, just by way of example, recently we came across this, a client who had an old format double dip will, and the double dip was looking at costing them maybe £140,000. So it's now possible to structure this in a way that avoids incurring that stamp duty cost, which in that example would have will save that client £140,000 of stamp duty. So the key message here is, if you have a double dip will, make sure you get it updated to the latest format so that it works optimally. We don't have time and space on this event to go into the detail of the ins and outs of how double dip will works. But if you don't have a double dip will, and you're a shareholder in a trading company or group, might be worth getting more of an understanding of that, how it works, the benefits and limitations. So you can see whether that could be beneficial, and we can assist further with that if required. So I'm now going to hand you back to Joe to talk about some points for those that might be looking at a potential business sale or exit in the future.
Thanks, Jerry. And that's very insightful, very helpful. It's very interesting, isn't it, that just by making a change to your will, you could actually save yourself 140,000 in stamp duty. Found that very interesting. So we're now going to go on to this point about business sale or exit. And here are some key planning steps to be considered or implemented, particularly for any business looking to sell or exit within the next 5 years. I think the key point is that the time to plan for business sale is now. There's a number of aspects to this which we've set out in something called our structuring for sale framework. That's a bit outside the scope of today's discussion, but it will be a focus for a future event, so watch out for that. The key thing to ensure is that you have the right structure in place now to mitigate tax costs on sale, facilitate reinvestment, and manage your inheritance tax exposure post-sale. So I think the key message here is don't leave things right to the last minute. Time to plan really is today. Inheritance tax reliefs won't apply post-sale. An example of that is you will have converted your assets that qualify for relief to assets that don't. So for example, cash, prior to sale, obviously you've got a company and you've got assets within that company which at least partially are exempt from inheritance tax. And we've seen examples of clients going from an IHT exposure pre-sale of say £1 million, and then once they've sold their business, they're exposed to the tune of 5 million just because they've sold their business. So you're potentially converting assets from protected assets to exposed assets by selling your business. Jerry, I think it would be good, actually, one of your case studies you have, if you go over that now, because there's a real life example of where this has happened. That'd be good.
Yeah, sure. No, it was just a recent example we came across of a business that sold not too long ago for about 20 million, and they're now faced with a big capital gains tax liability on all of that, obviously. And there's also the senior shareholder who's getting on in years, probably got a total estate of getting on for 10 million, and looking at an inheritance tax exposure of circa 3 million. So it's a bit of a negative example. We obviously weren't involved at that point, and you know, on reflection, if you like, with forward planning, it may have been possible to ensure, firstly, that they didn't necessarily have to pay all of that capital gains tax if there was an element of that they were looking to reinvest, and secondly, increase our options for mitigating the senior shareholders' inheritance tax exposure post sale. And I think this is a really fundamental point, because the sooner you start on this journey, the better, for two reasons really. One is you can start that 7-year clock going earlier. You can start that process of getting value out of your estate sooner, and also when the shares or when your stake in the business is worth less, so you might be embarking on a growth journey with a view to sale, it makes sense to get value out of your estate at the beginning of that growth journey before the shares have increased in value. So, as I say, bit of a negative example, but I thought it might just help bring some of those kind of issues and considerations to life.
No, thanks, Jerry. I actually found that quite surprising, that particular example, because they were with a big name accountant, but still didn't get the holistic view on both capital gains tax and inheritance tax on the sale of their business. So I think probably the advisors were concentrating on maybe just capital gains tax, and then overlooked the implications, you might say, on inheritance tax in that particular example. So it really underlines the importance of planning and getting sale ready, getting a inheritance tax friendly, you might say, structure in place now. So I'm now going to hand back to Jerry, who's going to talk to us further about removing capital value from your estate. Thank you, Jerry.
Thanks, Joe. So this is really just to explore what are the best and most effective inheritance tax mitigation strategies for shareholders, those that have got shares in a business, and there's and obviously other assets as well, pension funds, personal assets, other investments, etc. And there's, as always, there's a range of strategies that can be used, ranging from very simple strategies through to quite complex things. The simplest strategy is always just giving assets away, and we've touched on that earlier in this presentation. However, you might not be ready to do this for any of a number of reasons, and we've just tried to set out on this slide here some of the factors that might be considerations, and I won't read through them all, but it might just be very simply that your children are too young to start handing over ownership and control, or there might be concerns about potential for future conflict, or you might be wanting to just make sure that you've got funds available for investment or to support others to provide for your retirement. So there's any number of very real and legitimate reasons why now might not be the right time to just give assets away, lock, stock and barrel, as it were. If any of these sort of do describe the position you're in, then it's likely that other inheritance tax strategies are going to be more relevant to you. So going back to the slide we looked at before, talking about handing over capital ownership whilst retaining control and access to income. And I think that slide just shows that here. We can just move on to the next slide. The concept of giving away capital, keeping control on income. As I say, there's a range of possible options, but I think in our experience, it generally comes down to two things: use of trusts and a vehicle that we call a family corporate. Both of these essentially achieve the same thing, that is transferring value out of your estate but retaining control over it. Trusts are in particular very old and well-established vehicles which are still very useful in the right circumstances, but they do have various limitations, including things like that the original donors can't benefit in any way from the trust in the future. So you're the person that's put assets or shares into the trust, you can't benefit from those down the line personally. So the family corporate is designed as in many ways a more flexible vehicle, which has some key advantages over trusts, which include that there's no limit to how much you can put into a family corporate, whereas gifts into a trust above certain limits are subject to an immediate lifetime tax charge. Also, properly structured family corporates can be a very effective way to mitigate the capital gains liability when you sell your business. So going back to the kind of example that we were looking at before, it's a way of allowing us to reinvest that money and mitigate that capital gains tax liability on sale. The other thing is that, unlike a trust, the original donor, the person that puts assets into the family corporate, can continue to take an income from that, provided it's structured correctly. So in practice, both vehicles have their uses and benefits. So we often find that the most effective strategy actually combines both vehicles to give you the optimum outcome. The other strategy that we're talking to clients about a bit is a buyout of the either wholly or partially of the senior shareholder. This is slightly counterintuitive because it feels like you're putting more money into somebody's estate rather than taking value out of the estate. But it does have a number of benefits if it's well structured. And as we've just touched on this slide here, firstly, it gives the shareholder security of capital rather than just giving away all of your assets. You've got that capital backing you up, as it were. It gives you the ability to be able to draw down on that immediately and take money off the table, release your capital at often attractive capital gains tax rates. It caps your exposure to inheritance tax because you're no longer going to be getting the growth in value of those shares that you've sold. And also any undrawn capital, any capital that you decide to leave in the company can be retained and in the company and protected from inheritance tax. And finally, for what you might call the successor shareholders that are taking over the company, they can use, provided it's structured correctly, they can use company funds to pay out the senior shareholder over an agreed period rather than having to find personal funds. So it's quite a good strategy in the right circumstances. It's probably also just worth mentioning very briefly that what used to be known as entrepreneurs relief, we now refer to it as BADR. If you qualify for this, the current tax rate is 14%. It used to be 10%, it's gone up to 14%, and it's going up again to 18% on the 6th of April next year. So if you were looking at doing something like this, ideally, you'd look to try and get that in before the end of the tax year, while the rate's still at 14%. So just before we move on to the Q&A, we wanted to touch on some case studies. As you can imagine, we're having lots and lots of conversations at the moment, a lot of business owners about their inheritance tax, and we thought we'd just pick out a couple of recent examples just to try and bring some of what we said to life. So hopefully it's helpful. The first one was a married child who sadly received a terminal diagnosis quite recently. He owned quite a large house and also some land with potential for future development value alongside his shares in the family company, of course, jointly with his wife. What we did was to restructure their ownership. We put some of their property into trust so that any future development value is realized outside of their estate. And we also implemented double dip wills and kind of realigned the shareholding a bit to make sure that had the maximum impact on their liability, in the knowledge that it was likely in the circumstances that he would predecease his wife. So the effect of this is that ultimately we'll save them about £500,000 of inheritance tax. And more importantly, it's given the family peace of mind. His wife's cared for financially, and they've mitigated his inheritance tax liability, so they're not going to get some surprise bills at the end of it. The second case study was in relation to individual who'd taken over the ownership of the family farm and farm shop businesses from his elderly parents, which had obviously given him significant wealth on paper, but not necessarily a lot of cash. And his concern was that if anything happened to him, his family could be forced even to sell the farm to pay the inheritance tax, to pay the new rules. So he kind of succeeded in getting the value out of his parents' hands, who were quite elderly, but it was now exposed in his. And as is often the case, of course, with farms, the plan is for that to continue to be passed down the generations. They're not thinking of selling, but his children are all quite young, all at school still. So clearly it's not going to be appropriate for them to be involved in ownership and running of the farm just yet. So what we've proposed there is a new group structure involving a family corporate, which allows him to retain complete control over the farm and the associated businesses, whilst vesting the capital value across to his children through a trust structure. So ultimately, what that's going to do is save him from potential inheritance tax exposure of about 1.5 million. And again, more importantly, what it's doing is giving them peace of mind. It's removing this threat hanging over them of having to sell the family farm to pay the tax. So we could carry on, there's just countless examples of people we've talked to, different examples, lots of case studies we could bring forward, which time doesn't permit, but I thought it might just be helpful to go over those couple of examples before I pass you back to Harry for the Q&A.
Good. Thank you, Jerry. Thank you, Joe. Just before we move on to the Q&A, just going to go over a little bit about us, what we do here at Oldfield. Before I go on to that, though, if anyone does have any more questions for the Q&A, appreciate we've had some questions come in already. While things are still fresh in your mind from the information that Joe and Jerry have just given, if you just want to pop them in the Q&A box, that'd be great. But just briefly moving on to a little bit about us here at Oldfield. Obviously, first thing is that we really do understand that the content of this webinar may feel a bit overwhelming. It's completely normal to us. It's what we sort of deal with every day. So rest assured, obviously, if we're giving you advice, it's something we're well versed in. Here at Oldfield, we provide a clear, structured process to help you understand your IHT exposure, forward plan for that, and then also stay on track with the planning. Obviously, appreciate with these different tax events that are coming up, the landscape for IHT is ever changing, so it's something we like to keep our finger on the pulse with. And we pride ourselves on proactive support. Obviously, there's a lot less you can do with these different taxes, especially inheritance tax retrospectively. From a day-to-day perspective, we combine business growth advisory and accountancy services to help your business grow while protecting your legacy. And just briefly before we get into the Q&A, as a bit of a next step following on from this meeting, we're going to send everybody who's attended today a follow-up email where you can book a free one-on-one consultation to discuss inheritance tax with one of the tax team. Alternatively, if you would like to reach out to me, you can do. I know a lot of you will already have my email, but if you don't, my email's there on the right, so feel free to just take a screenshot or a photo of that, and I can channel you to the relevant tax expert for any advice that you need on that too. So just moving on to the Q&A, we've got a few questions that have come in. We're just going to start off with a question that we were asked for today's webinar, just because I think it's something we've had come up quite a few times. So I'm going to channel this one to you, Joe. So the question is there an option for me to move my assets into an offshore vehicle, like an offshore registered trust or company?
Thanks, Harry. Great question. And like you said, it's something that does come up from time to time. Frequently asked question, really, that can I move some money offshore and have an entity offshore in another country where the tax regime is more favourable? The answer to that is, if you are remaining as a UK resident, so you're remaining living in the UK, there's no advantage in using an offshore vehicle. The UK inheritance tax rules still apply to you in the same way. So obviously, if you were seriously considering emigrating or moving offshore, moving country anyway, could be relevant. And if that is the case, we do have contacts who can assist with tax efficient offshore jurisdictions. But if you're remaining as a UK resident, the best thing is to follow the UK-based strategies we've been discussing. So just an interesting point on that. I mean, people are leaving the UK by the score, if you know what I mean, for this very reason. But unless you were planning to do that, it's not relevant.
Good. Thank you, Joe. Hopefully that answers that question. Second question we've had come in: how does putting house, i.e. property, into a living trust help? I think we'll channel that one to you, Jerry.
Yeah, so there's different names for different things. I think we have to be quite careful with putting your own house into a trust in your lifetime, if that's what that's talking about. And the reason for that is because the inheritance tax rules largely prevent you from giving away your house and continuing to live in it, or at least if you do that, it doesn't achieve anything for inheritance tax. So we'd probably need to understand a little bit more context around the question to be able to advise on that, kind of outside of this forum. But I think the answer to that question is to tread carefully, because there are people out there that will try and sell things that don't necessarily work.
Good. Thank you, Jerry.
Just in addition to that as well, would you say, Jerry, that we'd have to say there is a bit of a health warning when it comes to putting money into trusts, isn't there? That you can actually trigger an immediate tax charge, which is payable within 6 months if you put money into a trust. So please don't go away from this webinar and just put money into a trust without taking tax advice.
Yeah, that's right. Yeah, exactly.
Yeah, absolutely. That's good. Thank you both. Second question that's come in. Is there an option of using probate to your advantage in inheritance tax planning? I'll channel this one to you, Jerry.
Again, I don't exactly know what's in mind behind that question. There's a 2-year time frame between immediately after death where there's things that you can potentially do to help with inheritance tax planning, particularly if you're talking about a married couple. On the death of the first one, there's things you can do within that first 2-year window. So I'm not sure exactly if that's what the thought process is there, but hopefully that helps give a steer anyway.
Good. Third question that's come in. How does a family corporate save tax? Again, probably one to send to you, Jerry. A really good question.
Yeah, so it looks, I think on that one, it looks like there's a bit more to the question a bit further down. I think if I'm picking this up right, how does a family corporate save tax when the value is presumably transferred to the shares? So try and explain that clearly if we can, which is that what you're doing with the family corporate, and there's some they're bespoke vehicles, they're relatively complex. We can't necessarily go into all the detail about the ins and outs of how it might be set up right here and now, but in essence what you're doing is you are transferring those shares out of your ownership, transferring assets out of your ownership into this family corporate vehicle. The point is that, and obviously as with many things with inheritance tax, often there's a 7-year window for you to get the full benefit of it. But the point is that we're getting that value out of your estate, but we're doing it in a way that leaves you with control over the asset.
Good. Thank you, Jerry. Next question. If I can afford to gift money that I have lent to my family, should I formalise this before the budget? Any comments on that, Jerry?
I think that's a really good question. And I noticed there's a couple of questions about, does all of this need to be done before the November budget? I think the answer to that is, when it comes to gifting, it's always the earlier the better, if you like. Remember the 7-year rule, and obviously remember the threat, we might say, of things being changed in the budget, that gifts after a certain date might be deemed to be in a different category to gifts before. So I think the answer to that is be wise, make sure that you can afford any gifts that you make, but certainly better done before the budget than after. And as a rule, the earlier the better. When it comes to structures, putting structures in place before the budget, I think it's fair to say, isn't it, Jerry, the key thing is gifting before the budget, really, and documenting those gifts. The structures might take a bit longer to set up, but there's a way of doing that. It doesn't all have to be set up immediately, you might say. Well, I don't know if you wanted to explain a bit more on that, Jerry.
Yeah, that's right. Yeah, it's the gifting, the transferring of assets prior to the budget that's the important bit, and the structure piece might have to follow along. Sometimes HMRC clearance might be necessary or desirable, so the process can just take a little bit of time to get it all set up in the way that you want it. But we can certainly help with the bit that needs doing before the budget and prioritising that. There's probably just one other quick point to mention on that question about gifting money that you've lent, and this is an area where HMRC have a rather strange view on this, which is that if you've lent money and you're going to effectively forgive or write off a loan, you need to do it in a documented particular way as a deed, get a solicitor involved in doing that. It feels like overkill, feels like unnecessary. But the danger is if you don't do it that way, HMRC could come back and say, actually, you never gave that money away. So again, as with all of the things we're saying, always a good idea to take specific advice on it.
Yeah, well, there's loads of questions coming in, isn't there, Harry? And I guess we haven't got time to answer them all. I don't know if I've ever seen so many questions coming in, which is really great. Just a quick point on that, which I know you were going to touch on anyways, that if your question is unanswered, someone will be contacting you to answer it personally. So just be assured about that. If your question doesn't get answered today, it will be followed up. But there's just one here I thought we really must answer, and that is that someone's asking that I've heard that having surplus cash on my balance sheet can be an issue for inheritance tax relief. Is that right? And is there anything we can do about this? So I think the answer to that is very, very good question. It is right. And it's a very important point. Where you have excess cash on the balance sheet, and by excess cash, we mean more cash than you regularly dip into for trading, HMRC may deem this to be an accepted asset and deny relief on it. The best way of dealing with it is to have a plan for the cash and then minute it in a board meeting. So, for example, you might, because of your growth strategy, you might need to move premises in 2 or 3 years' time. If that is the case, have a board meeting, agree as directors that is why we're building up reserves of cash, and then make sure you record that in the minutes of your board meeting. Obviously, again, we always say get advice on the point, run it past your advisor as well, but it's a really key point to make sure that you're minuting the use or potential use of surplus cash.
Good. Yeah, really, really good point there, Joe. Thank you for that. Just got another question that's come in. We're just going to sort of rattle through 3 more. And as Joe mentioned, if your question isn't answered on this webinar, please don't worry at all. We'll be straight back in contact with you to give you the answer to your question and assist any further that we can. So next question that's come in, do you have templates for new wills, or do we have to approach a solicitor? Good question, Stephen. Jerry, any comments around that?
Yes. So we'd always recommend getting a solicitor to draft wills. They are complex creatures of law, and it's easy to get them wrong. So, and particularly with the extra complexities on drafting, we'd always get a solicitor involved. Where we tend to like to be involved is essentially making sure that the will is structured in the way that's most optimal for inheritance tax, and also dealing with what you might call the more practical aspects of how assets should be distributed within your family, and making sure the relevant family members are taken care of, etc. So we've certainly got some good contacts that can help with that.
Good. Thank you, Jerry. I'm just going to go through 2 more. So next question we've picked out, if you put your house into a family trust and pay a rent, what happens if you need to sell it to go into care later down the line? Any comments around that, Joe?
So it's probably a fairly specific question. we'd probably need to understand a little bit more of the context around it. I think generally speaking, people are more concerned about getting assets out of their estate before they have to pay for care. So they can get more support from the government. And I think these are important considerations to think about, making sure you've got the right money in the right place. Also, you have to be careful with care home fees, in particular, because if you seem to be giving away assets for the purpose of avoiding care home fees, that can kind of backfire on you. So I think care is needed on that essentially, but probably one to pick up one-on-one, if that's all right.
Good. And final question, one for you, Jerry. Are HMRC aware of the family corporate vehicle, and what is their take on this?
Yeah, it's a good question. So yes, they are, in a word. It's a concept that's been around for quite a number of years, but it has recently kind of come to the fore quite a bit since the recent changes to inheritance tax. In actual fact, HMRC did open up a unit to look at these vehicles probably about 6 years ago or so. And our understanding is that they concluded that there was no kind of abuse or tax avoidance going on, so they closed down the unit, which I think is probably as close to a green light as we're ever going to get from HMRC. So I think at the time that gave the tax community a lot of confidence that this was a robust planning strategy that HMRC were comfortable with. So that's where we're at with that.
Good. Thank you, Jerry and Joe. Just moving on, really important point from us, which I think I've mentioned already earlier on. If you are looking to have a chat with us, whether it be just a question or whether you want to have a bit of a deep dive into your inheritance tax position and take some recommendations on actions that might be taken before the upcoming budget, please don't wait to get in touch, because obviously our capacity is filling up, as you can imagine, quite quickly. Ideally, get booked in sooner rather than later. In terms of a sort of next action point following this meeting, as I say, everyone will get an email from us. But if you would like to email me on the email that I showed earlier on in the webinar, or send an email to the info@ email you can see here, we'll pick that up straight away for you and get you booked in for a chat as soon as possible. Thank you to everybody for joining today. It's greatly appreciated and wonderful to see so many people here. From myself, Joe and Jerry and everyone here at Oldfield, thank you very much and have a good rest of your day.